There are many different types of investors and even more different investing strategies. However, they all share one common objective, which is beating the market. But what do we mean by market? Well, there are two main examples. The first one being the S&P 500 index and the second one being the MSCI World Index. In the graph on the screen, we can see how Fundsmith Equities Fund has not only outperformed the MSCI World Index, but it has almost doubled its performance in the 5-year period on the screen. How has it done this? Well, by focusing on a long-term vision. And as we like to say, the key to finding a good stock is just to look for a great company. But who is the man behind this fund? Well, it's none other than Terry Smith, one of the most underrated investors in the world right now. He is often referred to as the British Warren Buffett, as he has a straightforward investment approach by focusing on quality stocks with long-term growth potential and focusing on those which can compound over time, especially focusing on their cash flows. His impressive track record has earned him the respect in the financial industry, but I honestly think he doesn't get the credit he deserves. There are 5 main important metrics which Terry Smith focuses on when choosing his long-term compounders. The first one, and the most important one, is that they have a high return on capital employed. You can calculate this by using the EBIT over liability plus equity function. And the main logic behind this is that all companies have a cost of capital. The average number is 10%. This is how expensive it is for companies to obtain financing in the different sources, either debt or either equity. Now, in order for them to create value, their return on capital employed should be higher than this cost of capital. If it's lower, they will destroy value. Let me give you an example. Imagine Apple asks for a loan of $1 million and their cost of capital is 10%. Well, if they invest those $1 million at a rate of return which is higher than 10%, for example, imagine they get a return of 20%, well then they will be creating value by 10%, which is the difference between the return on the investment and the cost of capital. However, if that same $1 million they invested and they only get a return of 5%, then they would have destroyed value by 5%, which is the difference between the two numbers. That is why you should focus on companies who have a very high return on capital employed and which have been able to maintain the high return on capital employed for a very long time. The second important metric is that they have high margins, high operating margins and high gross margins. By having consistently higher margins than competitors, they're able to, first of all, stay ahead and get a competitive advantage. But secondly, they are more resilient and a safer investment if there is an economic downturn. Because in recessions, companies usually lower their prices, and by having higher margins, they have more room to be profitable if it came to that scenario. The third one is the interest coverage ratio. This is calculated by using the EBIT over interest expense formula. And the main logic behind this is that you want to know how well a company can pay their interest expense. The fourth one is the leverage. You want to find companies which have a healthy debt to equity ratio. And the fifth one is their cash generation ratio. You calculate this by using the percentage, by finding out the percentage of operating income that is converted to operating cash flow. But why do we care about operating cash flow? Well, because it's cash flows that we, the investors, receive in the end, not income. Now, these have a limit or a number which should be the bare minimum for your companies to have. And I believe that for the return on capital employed, you should be aiming for a 15% or higher. Of course, if you find a company like FICO, which has a return on capital employed of 40%, well, that is incredible. The next one is the interest cover. Your company should be producing an EBIT, which is 10 times larger than their interest expense. Next, they should have a 15% or higher gross margin. Of course, if you find a behemoth company like Visa or MasterCard, which have margins up in the 40% or 50%, that is even better. And finally, a good cash conversion. This ratio, you will sometimes find it in the 100% or even higher, and that's okay, but you should focus on obtaining companies which have it higher than 90%. But how do we value a stock correctly? How does Terry Smith do it? Well, he focuses on one very important metric, which is the cash flow yield. But not any cash flow yield, the yearly cash flow yield. You divide this by the market cap of the company and you will get a percentage. This percentage, for the price to be attractive, should be higher than the long-term inflation rate in the country. So for example, in the US, the long-term inflation rate is expected to be 3%. So as long as the cash flow yield of the company is higher than 3%, it should be an attractive price to buy. Of course, you can also use historic PE ratios. For example, get a graph of the historic PE ratios of the company, and if it's a bit lower than the average at which it has been trading all along, it could mean that it's undervalued. Of course, you can also run a discounted cash flow analysis, and by doing that, you should get the fair value of the security and figure out if it is at an attractive price or not. However, the main conclusion that Terry Smith always says is that as long as you've done your research correctly, the fundamentals are safe, and you have a long-term compounder identified, the price you pay for it should not be too important, as you will most likely get a very high return in the long term, regardless of the price you pay at the beginning. What are the three main things that factor in when choosing a great investment? Well, the first one is the moat. This is the strong competitive advantage your company should have, such as Google, for example, with YouTube or with their browsing. It's very difficult for a competitor to go in and try to take competitors away from them. The next one is for them to have consistent cash flows, because predictability and resilience here are key. And the third one is the high return on capital deployed. As we've spoken about previously, this should focus on creating value for the investor. When you sum these three factors together, the result is a great company which will provide you with higher returns in the long term. Here, when you're doing your fundamental analysis, these are some main things that you should focus on. Of course, you should include a lot more things like the management of the company and other things, but these are just some that can guide you at the start and help you identify good companies for further analysis. The first one is that they should have strong organic growth in revenues and free cash flow. Avoid those companies which have growth based on only acquisitions, such as, for example, AT&T. Next is those companies that can raise prices above the inflation rate without losing customers. One good example of this can be Netflix. They have been raising prices for a lot of time above the inflation rate, and they have not been losing users, but they have instead been increasing their user base. You should avoid those companies which are in a sector that have intense competition and have no clear competitive advantage. The third one is that you should focus on companies with a predictability of earnings and cash flows. This can help you get safe investments, which even if the company falls, even if the economy falls under a recession, they should perform well. Examples of these are Visa and MasterCard, which of course are the holy grail of companies you can invest in. And finally, you should focus on those companies which do heavy share buybacks program and also give out dividends. This is key because you should avoid those companies which waste their cash flows, since cash flows are the most important thing when valuing a company, since it's the money that us investors will get in return. So I believe that Terry Smith is one of the greatest investors. I really like his thesis. I have been implementing it and I feel really comfortable using it. I think analyzing companies in that way is great. Thank you for watching. As always, this has been the Cash Flow Compounder, and don't forget there is a link in bio for a free stock if you create an account with Trade Republic.